Assalamu alaikum. This is me, Dr. Saifullah, and I would like to welcome you to the second lecture of Advanced Financial Management. In this lecture, we will look at risk and its different types. This is a basic topic in which we will only define these different types of risk. In specialization courses, you will learn different ways to minimize these different types of risk. So we will start by defining risk. Risk is uncertainty about events or outcomes that can have a positive or negative effect on individuals, organizations, projects, or investments. Risk is simply uncertainty. It can have a positive or negative effect on individuals, organizations, investments. Risk is an inherent part of life, businesses, and decision making, and understanding it in details is crucial for effective risk management. One of the basic questions in risk management is that who is responsible for risk management? We have discussed in last lecture that the basic responsibility of the management is to maximize the wealth of shareholders, and maximization of shareholders' wealth is different from maximizing profits. Profit is simply an accounting term, and that can be manipulated by using different accounting techniques. So the best way is to increase the shareholders' wealth, and that will increase if the share prices will go up. And the managers, either financial managers, either marketing managers, either production managers, either supply chain managers, have the basic responsibility to maximize the wealth of the shareholders. So risk management is also related with the maximization of shareholders' wealth. Risk management is simply the safeguarding of the assets of the firm. So financial managers play a crucial role in risk management within an organization. Their responsibilities include assessing, mitigating, and monitoring various types of risk to ensure the financial health and stability of the company. Risk has basic two types: the systematic risk and the unsystematic risk. Systematic risk is simply the overall market risk that cannot be controlled by individuals or organizations. For example, inflation in the economy, political uncertainty, or market risk or natural disasters. These are types of systematic risk, and these cannot be controlled by individual organizations. Whereas unsystematic risk is the firm specific risk or sector specific risk. These risks can be easily managed or minimized by using portfolios or by using different techniques. But systematic risk cannot be avoided, and we have to bear it as it is. You can also see in this picture that the risk is divided into two categories: the systematic risk and the unsystematic risk. And we can minimize the unsystematic risk by using multiple stocks or multiple portfolios or multiple investment choices, whereas we have to bear systematic risk, and this cannot be minimized. The systematic risk can be classified into three categories: the country risk, interest rate risk, and foreign exchange risk. Country or sovereign risk, also known as sovereign credit risk or sovereign default risk, is the risk associated with lending money to or investing in a specific government or its state-owned entities. This risk arises from the possibility that a country may default on its debt obligations or fails to meet financial commitments. Recently, Sri Lanka has defaulted, and Pakistan has a high probability of default. And if a country has invested some amount in Sri Lanka or in Pakistan, then there will be a high country or sovereign risk for that country. As Pakistan has poor financial situation or Sri Lanka has defaulted on its debt, and in history we have many examples that the countries may default, and even big countries like Russia also defaulted on its debt. Country risk includes various factors including political, economical, legal, and social aspects, which can vary widely from one nation to another. The second type of systematic risk is interest rate risk. Interest rate risk is the risk associated with changes in interest rate and their impact on the value of financial assets and liabilities. Interest rate risk can affect various types of financial instruments, but it is particularly related to fixed income securities such as bonds. Normally, interest rate risk affects only if we have a mismatch in the maturities of assets and liabilities. For example, we have assets of 1 million and we have liabilities of 1 million and we have the same duration of that is 1 year, then the change in interest rate will have no effect on our firm, as our assets and liabilities both will mature after 1 year, and for the next year we will again acquire assets or liabilities, and their interest rate will be different from the first year. But from assets we will have a positive effect and from liabilities we will have a negative effect, and the positive and negative effect of interest rate will set off, and we will have no effect of interest rate risk. But sometimes we have mismatch in the assets and liabilities maturities. For example, our liabilities are for 1 year and we have invested our assets for 2 years. After 1 year, we have to pay back to our creditors, and to pay to our creditors, we need to borrow these funds again for 1 year. And when we will borrow that fund for 1 year, there might be chances that the interest rate will be uncertain. It can go up or down, and we have to face interest rate risk. Similarly, this type of risk is known as refinancing risk. Refinancing risk is a type of interest rate risk that the cost of refinancing can be more than return earned on assets investment. Sometimes we can have an opposite situation where we have invested our assets for 1 year and we have liabilities for 2 years. After 1 year, we will receive cash from our assets, but instead of keeping that cash with the firm, we will reinvest this cash for 1 year, and at this time the investment rate is uncertain, and this is known as reinvestment risk. The risk that the returns on funds to be reinvested will fall below the cost of funds is referred to as reinvestment risk. And the third category of systematic risk is foreign exchange risk. The risk that change in exchange rates between two different currencies can impact the value of financial transactions, investments, or operations involving these currencies. The risk is particularly related for individuals, businesses, and investors who engage in international trade, hold foreign assets or liabilities, or conduct businesses in multiple countries. This foreign exchange risk is specifically affecting our economy, as the exchange rate of the dollar is going up day by day, and due to this we have to pay extra prices for the products that we are purchasing. Now we are moving toward the unsystematic risk, and unsystematic risk has 5 major categories: business risk, financial risk, credit risk, liquidity risk, and off-balance sheet risk. Business risk is related to the fundamental operations and activities of a company. Business risk affect an organization's ability to generate revenue, maintain profitability, and operate smoothly. It is also known as operational or commercial risk. Some books use business risk and operational risk as simultaneously, but these have some minor differences. Business risk is a broader category that includes internal and external factors, whereas the operational risk includes only the internal factors. There are multiple factors that affect the business risk of the company. Competition in the sector is an important factor that affects the business risk. Similarly, demand variability, sales price variability, regulatory and legal framework, foreign exchange risk, product obsolescence, these are all important factors that affects the business risk. The next category is financial risk. Financial risk is the risk that mainly arises due to the company's capital structure. It arises from the choice regarding the debt and equity. Financial risk impacts the company's financial health, including its ability to meet debt obligations and obtain financing whenever required. General Electronics is a prominent multinational corporation faced financial risk due to its capital structure in early 2000s. High level of debt, particularly in its financial services subsidiary, GE Capital, became a vulnerability during the 2008 global financial crisis. As the crisis unfolded, declining assets value and concern about debt servicing capacity prompted GE to re-evaluate its capital structure and reduce its exposure to financial services, highlighting the significance of managing debt equity mixture of large MNCs. Many Pakistani firms have also faced the similar risk due to their capital structure. The next category is credit risk. Credit risk, often referred to as default risk, is the potential loss that an individual or organization may incur when a borrower fails to repay a debt or meet their financial obligations. Normally, financial institutions that make loans or buy bonds with long maturities are relatively more exposed to credit risk. But companies who make more credit sales are also more exposed to the credit risk. Subprime mortgage crisis 2007-8 was the biggest example of the credit risk, and it has affected many companies in US and across the world, and mostly big financial institutions like Lehman Brothers, who was engaged in mortgage financing, was more exposed and filed for bankruptcy due to credit risk. The other category is liquidity risk. Liquidity risk is the risk that pertains to the ability of an individual or an entity to meet its short-term financial obligations promptly and without incurring significant losses. It involves the possibility of not being able to convert assets into cash or obtain the necessary cash or cover liabilities when needed. The global financial crisis highlighted the liquidity risk in many companies, and many companies filed for bankruptcy due to the liquidity risk. The global financial crisis was triggered by a combination of factors including a housing market crash, the subprime mortgage crisis, and widespread losses of confidence in the financial systems. Many financial institutions, including major banks, faced liquidity issues as they held complex and illiquid assets that were difficult to sell. This liquidity risk contributed to the panic in the financial markets and the need for government bailouts and interventions to stabilize the systems. The next important category of unsystematic is the off-balance sheet risk. Off-balance sheet risk refers to the potential risk that a company or financial institution may face due to activities or transactions that are not recorded on its balance sheet. These activities or transactions may involve contingent liabilities, contractual obligations, or financial instruments that, while not appearing directly on the balance sheet, have the potential to impact the entity's financial health and performance. It is important to note that the off-balance sheet items are not inherently problematic or unethical. They are often used for legitimate business purposes such as risk management, financing flexibility, or optimizing financial reporting. However, investors and stakeholders should be aware of these off-balance sheet activities and their associated risks to gain a more comprehensive understanding of a company's financial health. Technology risk is also a type of unsystematic risk, and technology risk, also known as tech risk or IT risk, refers to the potential for adverse events or failures related to technology systems, infrastructure, or processes that can impact an organization's operations, data security, financial performance, or reputation. In today's digital age, technology is an integral part of nearly every aspect of the business. It is important to understand and manage technology risk effectively. Recently, Knight Capital Group in 2020 faced a technology risk. The Knight Capital Group, a prominent electronic trading firm, experienced technology failure that resulted a loss of approximately $440 million in just 45 minutes. The incident was caused by a faulty software deployment, which led to a series of high-frequency trading orders being executed erroneously. Operational risk is also important type of unsystematic risk, and the operational risk is the risk of loss resulting from inadequate or failed internal processes, systems, peoples, or external events. It includes a wide range of factors that can disrupt an organization's business operations, lead to financial losses, harm its reputation or result in legal and regulatory penalties. Operational risk is a significant concern of businesses across various industries, and it can stem from both internal and external factors. One of the biggest examples of operational risk is the collapse of Bearings Banks in 1995. Bearing Bank was one of the oldest and most respected bank in the United Kingdom, and it was bankrupt due to operational risk. Insolvency risk is also a type of unsystematic risk, and insolvency risk, also known as bankruptcy risk, refers to the probability that an individual, business, or entity will be unable to meet its financial obligations, such as repaying debt or fulfilling contractual obligations as they become due. That's all about the risk and its types. In the next lecture, we will discuss about the capital structure theories. If you have any questions, you can contact me. You can contact me by writing in the comment section, or you can ask question through WhatsApp. Thank you. Take care. Allah Hafiz.